Hello, everyone. I'm Joe Welu. Thanks so much for tuning in to Expert Insights, where we talk with industry leaders across modern financial services to discuss leadership and innovation. Let's get started. Hey, everybody. Welcome to the podcast. Excited today to be joined by my good friend and industry expert, Julian Hebron. Julian runs one of the top consultancies in the space called The Basis Point, and one of the smartest guys I know in terms of understanding the trends in the market. What is the data telling us? So Julian, how you doing, bud? Good to be with you.
Doing great, Joe. And I know that you probably have a zinger to start out today, so let's get into it.
Yeah, man. So you've been telling me that the worst is over, and specifically over the last month or so, we've talked about this, but I got to tell you, man, the data that I'm seeing doesn't necessarily make that super clear. And so, A, do you think the worst is behind us as far as the lending market, the mortgage market? And if you do, what are you looking at to derive to that conclusion? I think there's a lot of people that would love that insight.
Yep. First and foremost, just like it takes a minute for the Fed data to permeate through the economy, is the worst over in terms of lender profitability and multiple quarters of struggling for profitability? Probably not just yet. But if we turn to the rate market, which obviously has the most direct impact on all of these factors, also a little bit of a challenge. I'll just throw up a slide to start right away, because I think to your point, when not only we look at the pain that's happening on the ground, but the rate chart says the story. We peaked in October, late October 21 of last year at 7 3/8. We're pretty close to 7 8 today to start August. It's the last 5 months of the year. And that's pretty painful, extraordinarily painful for the producers on the ground, just as painful for the operations and lender profitability. So yeah, I can see where the challenge of the question comes in. And if you're okay with it, I was going to just kind of walk through why I do believe when we look at other data, forward-looking from highly credible sources, that maybe the worst is over and we're darkest before the dawn here.
Yeah, I would love to understand that. Obviously, from a single lens of, hey, I'm running, I'm at a bank or a lender, I'm in charge of the operation, I'm running sales, I'm maybe an executive at one of these companies, or I'm trying to make my living as a producer that's helping consumers get into homes and refinance loans. And I'm looking at these rates in this chart. I'm like, this does not look very inspiring to me in terms of rates. So let's get into the rest of the data and what you believe is setting the stage for us to be in a better spot over the next 6 to 12 months.
Yep, I'll zip through it super fast, and I'll kind of focus on December. We'll like, that's 5 months away. Like, we're starting today. For those listening, Joe and I are recording this on August 1st. 2023. So if I kind of get into where we were, everyone knows this, but just to recap, I'll say it for people that are not watching this and just listening. 11 straight Fed hikes as of last week, July 26th. You go back to March 15th, 2022. So you've got about 16 months of rate hikes totaling 5.5%. And that's where we are. So one of the things that I like to look at the Fed funds charts for is because after each one comes up, like we come down, we haven't been this high since those post-crisis years, right? Or, well, I should say pre-crash years of 08, right? So you go back to 06, 07. This is the last time we were even near these levels. And if you look at the chart that way, what happens afterwards? Okay, so we know this is the worst it's been. But if we keep going, the jobs picture the jobs have held steady. Wages have held consistently high. We know that unemployment is also at this multi-decade low, still at 3.6%. But most critically, let's just get into like headline CPI, because that's what all the consumers that we as an industry serve see and hear the most about. And then we'll do core PCE, which is the one that we care most about, because this is what influences Fed policy most. So
yeah, and for those of our listeners that don't necessarily obsess over this kind of data like maybe we do, explain just a little bit on, as CPI starts to come down, how does that impact what they do with interest rates? Obviously, I think the obvious points are inflation feels like it's coming under control, which would certainly make a case for pausing rate hikes. Is that the right way to look at it? Maybe go into that a little bit and just set the context.
Yeah, we'll do the CP. Why don't I'll talk about it through the consumer lens on the CPI part and then the lender lens on the PCE part, because we do have some wonks listening too, right? But even to the wonks and everybody else, I would say June headline CPI, which just came out, 3.1%. For the consumer to hear this, it matters because it means that this sentiment that they have of like inflation has been so high for a couple of years, all they hear about in the headlines, at least that's why CPI is called, quote, headline inflation, because this is what people hear about. And at 3%, if we hold this line, and by the way, we're at 3.1%, if we tick down into the twos, people start to have some confidence that things are maybe okay, right? So I think that's
and to ground on it,
deal.
the target the Fed is stating is they want to see that core inflation come down to what range?
The Fed's target is always 2% for all inflation. And again, they peg very, very closely off core PCE, which is actual prices that people pay for stuff rather than an index, which is what CPI is. That's very wonky. But I'll share one other thing that matters for people that hasn't hit just yet. It's within the CPI. It's within core CPI, which core CPI is a little bit higher. So again, headline, the number with everything in it, 3.1% as of June. Core is 4.8. It is down, but it's still being held up by rents because the rent component of CPI is still at 8.3%. And for those that don't follow this stuff super closely, that's based on leases that were signed a year ago. So, and rents have stayed reasonably high. So we don't think that that's going to drop off materially, but it will drop off as we kind of go forward over the next 5 months. And we'll see that number coming down a little bit more. And all of this, again, for the consumer mindset, I think there's two things. One, the headlines do influence people and they get a little bit more confident. And two, Joe, you and I have talked about this a lot, but when you look at these Fannie surveys, which we're not going to get into today about homebuyer sentiment, worst time to buy ever, same data set also says that a vast majority of people still would plan to buy if they were moving within 12 months. So kind of home ownership is baked in. Kind
of a key takeaway, Julian, if I'm digesting this data, a lot of our customers, a lot of our listeners out there are in a space where they're interacting with consumers. And in many cases, they're a source of knowledge to their customer base. And so if you're in the industry as a practitioner right now, having the lens of understanding how this data is moving and how it is going to shape the next 6 months, 12 months from a consumer sentiment standpoint, I believe is important. And that's really where we're spending some time on this data, right? Is really understanding what is the actual narrative, where are the trends heading, and then ultimately, how should you be translating that into the right message that you're taking to the market? Because you and I both agree, unless you've changed your position on this, that being inside the industry as a banker, or a lender, or a practitioner, part of your job is to set the right narrative for your customers. And so you're not subjecting them to only what the headlines in the media say, which sometimes don't tell the full story. Am I thinking about that right? And anything to add on that?
Yeah, I would offer this just for fun. For those that are only listening, take a minute to go check out the video version of this when you're done. And for those that see it on video, the chart that we're looking at, Joe and I right now, the chart tells the story. And inflation, the chart looks pretty damn good right now. Fed funds is still going up, but CPI, the one we're looking at on screen right now, is materially coming down. So if you need to meme that and make it sexy and cool on social, that's what you got to do, man, because that's what you got to break through. And finally, Joe, going back to your opening question today, this is why there is a real case for the worst is over, because the CPI chart says it all.
Yeah, absolutely. And I mean, naturally, as inflation peaks and starts coming, we've seen it peak. We're starting to see it come down into, like, it feels like it's not, 2% is not that far away from 3.1. I know there's more to the story, and certainly we've seen false positives before and things turn the other direction. But you have to believe there's a high probability with the sheer amount of rate hikes we saw as that's making its way through the system. You're seeing that impact here. And so I guess our message to the listeners is tell this story, right? Use this information to educate the public on what's actually happening. So let's keep rolling, bud.
And I'll just, again, underline it. I'll keep rolling, but have fun with it, because that's what breaks through to people. people, and you finally can. I know it's not fun looking at your pipelines right now, but what is fun is like you actually have a story emerging here in the last 5 months of the year. So if we go to core PCE, you'll get a little bit more technical here. This one hadn't moved. We're going to just show February to June today, okay? But if you look at core PCE, which was the Fed goes for most, they need this to be close to the 2% range. But Joe, to your point, even when you get into the twos, even if they're upper twos, we know that the bond market will react positively, and we will come, I think, all the way through the sixes and start touching the fives. Okay.
So just recap that really quickly so people can translate how that makes its way. You mentioned the bond prices for those of us, those of our listeners that don't necessarily understand how that works. Can you just explain briefly kind of how that impacts bonds and then how that actually translates into mortgage rates coming down?
Yep. So it's pretty straightforward, but when bond prices decline and a sell-off, rates rise, right? And so what's been happening is that the markets have been selling bonds, including mortgage bonds, as the Fed has been on this inflation fight and as inflation has been really high, because bonds don't have an appreciation for inflation because it erodes their future cash flows. A bond gives a fixed
because
payment
it's all
to an investor.
it's all based on the yield and the cash flow that associated yield has. Those become less valuable as the rates are rising. They can get a better yield on that rate moving forward, right?
And the same works in reverse. So when the bond market starts to believe that we are through the worst of the inflation, buyers start coming back in, pushes the bond prices up and the yield rate back down. So if we look at February to June, these 5 months for core PCE, which is what the Fed looks at most, 4.7 was in February, and then 4.6, 4.6, 4.6. It didn't barely budge. And then this past read that came out last Friday for June, down 50 basis points to 4.1%. So again, once that one ticks into the threes and we're now within 20 basis points and we gained a full 50 basis points in 1 month on that, if we even gain 20 more, the market sentiment in the bond market will shift materially, and then you will see the rally come and then the actual mortgage rates come back down.
So if we see the next print on these numbers that we're showing here have a meaningful adjustment, what you're saying is there's a high probability that that's going to change the sentiment for the people that are buying, the organizations, entities that are buying these bonds. And as they get back into the market, buying those bonds again, it's going to change. It's going to put downward pressure on interest rates, correct?
Correct. And there's something that's really important about the bond market is that it is the smart money in the global capital markets. So they will be the ones that tell the Fed, like, all right, we believe you now. So
if I had to sum it up, Julian, just to oversimplify, a lot of people predicted, including some pretty well-followed economists or self-proclaimed economists maybe in our industry, really projected that we would be into much lower rate environment that we are today. And the challenge with that is they were making those predictions maybe ahead of actually seeing the consistent print on these inflation numbers coming down to a threshold that was within striking distance of a point where it really did change the dynamic in those bond markets. And that's really the disconnect that we've seen from saying, well, why are we still in the sevens, right? And the answer from my lens is ultimately you're just now starting to see data that fully supports that inflation is coming under control. And as that becomes more and more real, hopefully every month, it should take us in the right direction, hopefully.
And for what it's worth, you hear these fancy terms like soft landing. What does that mean? It just means that maybe typically when you do this and you hike 11 times for a total of 5.5%, which by the way, those hikes are for overnight bank-to-bank lending rates, and that then thereby slows everything else down, supposedly in the economy. And everyone was like afraid that we were going to come to a screeching halt and move into a recession. But the soft landing is consumer strong, employment holds, but we bring inflation back to more normal levels. And if that's the case, and we're going to get into some housing units and sales now, you got to communicate to your consumers that home prices are not going to crash. If anything, we might have seen the worst of home price declines already. So if we want to transition to that,
I think this is let's do that. And I think that point is really an important one. And we've talked about it a couple of times already today, but I want to emphasize, as an industry, it is so critical to provide the right education to the consumer consumers, because people are making decisions a lot of times on what to do in their life, and the financial journey that they're either on or would like to be on is getting changed based on their perception. And that perception sometimes is grounded in reality, and sometimes it's grounded in headlines that they don't necessarily properly understand or that the media isn't properly explaining. So really digging in here is an important component for all of us to remember.
I have a fun one before we do the housing bit. I'll do these real fast. Again, on CPI and core PCE on the outlooks. So I'm changing the slide for those who are only listening and not watching. But we have a fun chart that we've been doing, and it's just coincidence, but we call it like, will the U.S. inflation spike flip off by December 2023? And the reason we say that, because when you look at the chart, it looks like inflation has been flipping us the bird the whole time. That's what the chart looks like.
It kind of does, doesn't it?
It's low. It was low in 2020, horrible in 21 and 22. But by the time we get to the end of this year, Goldman Sachs is calling for inflation to be CPI headline at 2.9%. And as we just discussed, we're already at 3.1. That's 4.5 months away before we get that. It's 5 months away before we get that print. Okay. So this could actually turn out to be better than what we've got. And then when we go to core PCE, same thing. Goldman's calling for 3.4% on core PCE by December 2023. It could be, based on what we're seeing trend-wise, that also could end up, as we just talked about, even if it touches in the high twos, bond market moves well ahead of that, and rates move accordingly down.
All right, Julian, I got to share with you some of the conversations that I've been having, and I want you to relate that to the data and what's happening. Okay. So I try to have half a dozen or so conversations a week with senior leaders, executives in our customer base, and also our partners, many of which are tech companies that serve the broader banking and lending ecosystem. And what they're telling me is the inventory, as far as the mortgage lending market, the inventory shortage is actually a bigger problem than the interest rates. And they're saying in many cases, there's plenty of demand, even with rates at 7.25, there's plenty of demand for purchasing a home, but there's just not enough properties. And I think a lot of us that study the industry are struggling to see how that gap gets closed, even if rates, and because here's what we see, right? You have a bunch of people that got into homes during these incredibly low, historic low interest rate environments. And for them to want to go from a 2.75 or a 3.5% mortgage up to a 7+% mortgage, they're not going to do that unless there's a life event driving it. And I think a lot of the transactions, a lot of the homes coming on the market today are life event driven. But can you walk me through the data, what the data tells us? Like, how do we, even if rates come down, let's call it sub 6, which I think everybody would be ecstatic about right now to see a rate with a 5 in front of it. If that happens, does it impact the inventory problem at all?
I think the short answer is absolutely yes. So again, we'll do two answers. The consumer takeaway is, and a lot of your listeners know, but we can't emphasize it enough. We've said it a few times, but do not let your consumers think that home prices are going to come down, because just don't. Because, Joe, to your point, if we go to this next slide that I'll put up on the screen for those who are watching, approximately 5 million units in total, new and existing, will sell this year, right? That's off from like a normal market of, say, 2019 of 6 million units.
And I still hear a lot of just regular consumers when I have conversations, people waiting for a bigger price correction in housing, assuming the higher rates. And it's just simply not true based on what we're seeing today. And if you think back to 2008, the financial crisis that we went through, you saw inventory levels explode and balloon to levels that you had in many cases a year, 2 years worth of supply. And in most markets today, we still are in the 1-2 month supply, if that, in some markets. And so you're just not going to see the likelihood of filling that big of a gap in inventory, which would be required. You'd have to have an oversupply to see pricing come down. We're just not seeing that it just doesn't seem logical that's going to happen. That's really what you're saying, right?
Yes. And for what it's worth, again, I'll just read these off for this year, but like median price at like $385 for existing and $427 for new. Technically right now, that's what MBA is calling for year end. But right now, the real reports that both of them just came out in the last week and a half for new and existing home prices. Existing is at 410 and new is at about 415. Those are the median prices. And if you take today's rates and 5% down, and this is a huge takeaway in my view for everyone listening, you need to make, if you have no housing debt, you need to make around 93K. If no non-housing debt, if you had about 600 in credit card, student loan, car loan, you need about 110 to qualify for an existing home. And if you had about that much debt for new homes, you need to make about 115-ish. So it's not low, but it's not unaffordable. Like so
it's
many
not,
headlines.
It's affordability. And if you look at a lot of the headlines and you kind of dig in a little bit, affordability is looked at as almost catastrophic today. There's an affordability gap. And I do believe, based on what I see, particularly with our bank customers who pay really close attention to certain segments of the market, lending into underserved markets is a major initiative for a lot of our customers. And they see it pretty pronounced, their profound affordability gap. And what you're saying is, at a macro level, the affordability gap is while it's certainly there, it's not as significant or as catastrophic as maybe we would like to believe. And I think some of it is we're just comparing it to these artificially low rates that, let's just ground on the fact that 2020, 21, it wasn't reality that we were going to see 3% interest rates. So if you're comparing it to that, of course, affordability is terrible. But if you ground on the kind of some of the data you're talking about, the affordability picture isn't nearly as bad. And Julian, are you seeing, long term, we're starting to see a little bit of innovation on the product side, the types of loan products that are there, down payment programs, like you're starting to see more and more of that, which is going to help with affordability. Is that what you're seeing?
Yes, but I would put a little bit of a caution there. I don't like moving down the credit scale just for the sake of volume. But what I'm saying is that when we do our scenarios every month on new and existing home sales, even at like the prices that we're at, okay, so the peak for existing home sales, which is 85% of the sales in total, right? The peak was June 22 at 413. June 2023, we're at 410. So you're pretty close to the peak. You have these peak rates, but even then, you still need between 98 and 115K to buy. And you can, with 5% down at today's supposedly nosebleed rates. And Joe, to your point, the people that cover this stuff are either haven't seen a market, like a market with elevated rates before, or they are looking at data sets that use like 28% debt to income ratios. And that's just not how loans are made in this country.
Yeah, that's fair. That's fair. All right, let's move on.
Okay, so just real quick, I mean, this is kind of what everyone knows, but what I like to focus on is just, I said before, darkest before the dawn, 3.29 million loans total this year to buy homes. That's probably going to be the low for the cycle. The market is 77% purchase. And then you slowly will start to tick back up in total number of loans available. So it's based on these rates from MBA calls the end of this year at 5.9% and Fannie Mae calls it at 6.6%. To your point, I'm more in the MBA camp. I think the rates have a 5 in front of them over the next between now, August 1 and December 31. It happens this year. You can call me on it if I'm wrong.
Let's document this, guys. So you're saying rates in your mind could literally be at 5.9 by the end of this year?
Yeah, MBA is calling for 5.9, and I agree that rates are in a 5 handle by December 31.
That'd be
this inflation data.
I think that'd make a lot of people feel a lot better, right? And so, to our earlier conversation, it doesn't necessarily fix the inventory problem, but it certainly does get things headed in the right direction from our perspective. So that's great. I hope you're right, buddy. I hope you're right.
Mike Fratantoni at MBA and Doug Duncan at Fannie, like these two, they lead the economics teams at those two orgs, and they know what they're doing. And I'll just take it one step further to 2024. The MBA team thinks that rates have a 4 handle. I'll be at 4.9 by the end of next year. But Fannie's still holding the line in the 6s on next year. And Doug has been more conservative, but I greatly respect that team.
Do we have any data on their historical batting averages that we can look at?
Duncan is his batting average has held up. He's won awards for it recently in these current cycles.
And is he the one
believes in
predicting
higher for longer.
4.9? Is he the one?
No,
No,
no.
he's the one.
Frat
No,
and
okay.
Tony says 4.9 by end of 24.
So the guy with the
and
higher
Duncan
batting average believes that it's going to be in the sixes. Okay.
higher. I just disagree because of what we talked about before. I do believe that the bond market will react extremely strongly when we see these core PCE numbers moving into the twos, and that could happen as soon as this year.
Hey, Julie, let's transition into the industry, the organizations that serve the lending community, consumers everywhere, banks, lenders, credit unions, how they actually end up navigating this cycle, both what we're seeing right now, kind of mid-cycle, mid-late cycle, and how we think this is going to be different, right? To where we've grounded on the recovery is not going to be created equal for all organizations. Take it from there and give me your thoughts.
Yeah, let's look at the mortgage sector just because it's the hardest sandbox to play in with respect to the complication of the product set, the level of sophistication that you have to communicate to consumers about all the things we've talked about, and then just the capital requirements, everything else you need. And so let's look at market share. So Inside Mortgage Finance just released their first 6 months of 2023 rankings. And I just want to focus on market share. Of the top 20 lenders, they carry 51.6% of the market share for the first half of 2023. So what does that tell me? It tells me that people that are leaning into this are gaining more, a lot more. That's 20 lenders that have the majority market share.
What was it historically? I know it was much less than 50%. I want to say it was more in the 30 range or something. I don't know if that's
correct.
accurate.
Yes.
Yeah.
And
Yeah.
I think that...
So the top 20
Go ahead.
directionally, not exactly, but directionally are on pace to, if they keep going, essentially double their market share in this cycle. I mean, that's within the realm of possibility.
And we know that this cycle has been special. It's been especially hard. I guess my biggest takeaway, though, is if you have the ability to lean into this a little bit, it's already been tough. But if it's a matter of survival, it's understandable that you have to go as lean as possible. But if it's a matter of austerity versus taking a little bit of risk, if there was ever a moment to take a little bit of risk and invest a little bit more, do an acquisition, lean into certain types of tech stack that you've been thinking about but haven't done yet, these are the moments when we're finally maybe through the worst of this.
Yeah, and what we see, and I do think there's, even if you're not in the top 20 or near the top 20, there's equal opportunity for those organizations to take share from the other organizations that are in their sort of quadrant of the market, right? And so we see even small to mid-sized lenders, we see dramatic differences between kind of how they're behaving, how they're navigating this environment between one to the next. And thematically, the things that we see, part of it is just the mindset that they have, and they're really getting creative. Like you said, in some cases, they're making acquisitions, very strategic acquisitions. They're taking on production where somebody went out of business potentially. They're coming out to their vendor partners, kind of the important vendor partners, and they're saying, hey, we're going to get rid of everything that's not essential, and we're going to go deeper with the people that, you know, we believe can invest alongside us for the future. And so we're seeing kind of those behaviors being the patterns of the ones that are winning and certainly outperforming the ones that are not. They're certainly all have taken measures around cost control. And I was talking to small to mid-sized lender this morning, and he's like, look, man, you know, my biggest priority is I need to protect my most invaluable people. I need to be able to pay those people. Then from there, we're really doubling down on our core customers, our past customers, our book of customers, because they don't necessarily have the budget to go out and buy leads and do tons of marketing. What's the most inexpensive thing that they can do? And a lot of times it's taking that past customer book that you've built over 10 plus years and actually just using data and finding really efficient ways to drive business from that. So those are some of the patterns that we see happening. I'd love your perspective and your lens on it, because I know you talk to a bunch of people as well.
Yeah, a couple things. And I don't like to be all like prescribing, you know, apple orange comparisons to people, but I will make one that's notable this week with respect to Rocket bringing in a CEO from the more of the fintech world. So from Intuit is where their new CEO comes from, effective this week. Oversaw TurboTax, Credit Karma, Mint and all their consumer products. So that mentality, to your point, that goes to lead buying. It goes to a heavy, heavy investment. You don't have to do that. I like
It
what you
goes
said.
directly into understanding customers and customer data and
Yes.
utilizing that as your primary drivers of business and primary ways you drive, the UI, the way the experience is between customer. Like those organizations spent decades mastering that. So the fact that Rocket is going outside of their industry and outside their normal house of executives, which they have, I know many of them, and they have a stable of amazing executives. The fact that they're thinking differently, I think should send a message to the market. Wait, maybe we need to think a little bit differently as well about how we're approaching the future. At least that's the takeaway that I took from that.
And so here's what I would love to underline for everybody listening. This is super important. I've been doing this a long time, and I often hear when really big moves, which by the way, have led to these substantial market share gains for a firm like that over a full 15-year period. Everyone's like, yeah, well, we can't really do that. Not true. As the fintech sector that powers you matures, you absolutely can do that. So Joe, I want to give like an example. So people think, well, oh, I have to get at the data in that way and to do all these other things, I have to have an entire proprietary tech team and I have to build Salesforce all custom or whatever it is. I just don't think that's true. I know it's not true, just given the work that we do. So I don't mean to flip it back on you, but I think from where you sit and the way that you've matured, you're one of the firms that's a good example of like, you can power a firm like that even when they have bigger parts of their machinery. But then every other firm that's like, hey, we're on austerity right now, we can't do that much. How are we going to get at our data? That exists today, correct?
Yeah, it absolutely does. And there's certainly firms, we're very fortunate to be one of the key firms that serves the industry, and some of those use cases on how to activate and take action on important data, how to ingest it, how to make it valuable, basically, how to extract insights and then turn that into growth in the business, right? And I agree with your statement that whether you're working with us or other organizations, you don't need to have this gazillion-dollar budget. And chances are, if you've picked sort of any of the firms that are still around, because we've seen a lot of tech as well get punished over the last couple of years. If you're working deeply with any of the firms that's still around, having continuous conversations with those partners on, okay, what are the additional things that we can do together? What are the additional ways we can create value together, right? Having that mindset of collaboration, because it's usually not just one thing, right? I think that's what people believe it is it's one big power move. And in some cases, that big power move kind of puts some things in motion. But a lot of times it's just looking at the problems differently and asking different questions, right? It's asking questions like, wait, why can't we drive more business from the 50,000 people we've served over the last X number of years? Why can't we? What's preventing us from doing that, right? And how do we create opportunity? And so we see it, partly as the tech partnerships, but it's also asking different questions differently. That's what we see.
I'll add to that and just add a pragmatic note to it, because it's not just about asking those questions. You have to ask the questions of what is in your existing stack. They do work. And what we do at the basis point is look at everything all the time. That's why we host all the demo programs around all the industry, because every time we look at the firms, Joe, to your point, that are the last firms standing in this part of the cycle, everyone has done stuff that you have not seen in the last 3, 6, 9 months. So if you're not looking at these parts of your stack deeply and saying to the folks that sold them to you, what have you done recently? I promise you, if you do, you will see new stuff, and it does help you, because that's what we've been doing in this cycle. And Joe, I'll commend you and your team, because some of the stuff you've built to be able to get at some of those opportunities, a lot of them have happened in the last 3, 6, 9 months.
Yeah, a lot in the last 9 months for sure. And a lot of it, I mean, we're very fortunate that we have a lot of great customer partnerships, and we look at it as partnerships, right? And it's not just true for us, but it's true for a lot of what I would say category leaders. And to your point, we've seen, not everyone, but we've seen a lot of what I consider the category leaders at your core components of your tech stack have done some pretty meaningful innovation in the last, call it 12 months or so. And so if you're not staying close close and asking those questions of those partners, take the initiative, have the conversations, get educated on where they're going and how they're helping lenders in ways that maybe they're not helping you. Like one of my favorite questions, and I got the customer asked this of me, and he's like, what should we be taking advantage of today that could help our business that we're not doing right now? Very simple question, but I thought there's a lot of power in that question. And this particular leader, had the awareness to say, hey, maybe we don't know everything. Maybe there's some things we can pick up on. And he asked it in that way. And I just thought that was a great approach. And I would encourage other organizations and leaders out there to ask those same types of questions from your tech partners that you're already invested in many cases, right? You've already got a multi-year relationship. Why not ask them, hey, how could you guys be helping us more with things that we don't necessarily take advantage of? And you'd be surprised where some of those conversations will evolve to.
And I mean, I might sum it up all by this, which is like, how are you using that part of your operation, your technology, to have a permanent, real-time, ongoing lens that's a dynamic profile of each customer? Because when you have that, that's where all the opportunities just shake out. And we are very rate sensitive at the moment. And the second we start to see that stuff come down, you've got consumer debt that's extra high. You've got housing debt that once it comes back into the fives, you can do consolidations where the blended averages are all going to work out mathematically for the consumer. But that stuff you can have real-time lens on. And if you don't, these last 5 months of the year are the time to do it.
And your point, that's exactly what we were talking about when we were saying, hey, the recovery and the curve going to the upside, it's not going to be distributed equally, right? The organizations that do have those capabilities and quite frankly, not just the capabilities, but have set their organization up to execute on them, because that's also one thing we're seeing out there is people really evaluating the teams internally saying, okay, do we have the right talent to be able to lead us to this next chapter in modern lending, modern banking? Do we have the right people? I know they've been here a long time, but those are not popular conversations, but we see the best organizations asking those hard questions as well as the hard questions on the technology and whatnot. So really, really good commentary, Julian. Agree with your thoughts there.
Yeah, no, thank you. Appreciate it.
So Julian, in closing, one of my favorite things that you do, you always seem to weave in whatever's happening in pop culture and somehow tie that into the industry. So what's like the pop culture thing right now, and how does it relate to what we're dealing with in the industry?
So there's only one pop culture thing this summer, obviously, which is Barbenheimer, which is like the Barbie Oppenheimer, dual gigantic box office openings on the same weekend 2 weeks ago. So I can tie that to the mortgage industry if you want.
Yeah, I think I heard you saw the Barbie movie like 6 times. Is that true?
Well, yeah, I'm just trying to get jacked like Ken, so that's, I got to study up.
All right. Yeah, no. All right. Wrap that up for us.
All right. Well, here it is. Like, this is a huge story because that industry, Hollywood, is under incredible upheaval on the same level that I think a lot of us are feeling in banking and lending, right? So I think there's 3 things. One, old school tactics are cool again. It's movie theaters versus streaming, right? So banks and lenders are just under siege the last 10, 12 years of like, oh, tech's going to have its way with you and eat your lunch. Not true. You still have to bring the talent, everything that we talk about just superpowering the humans to do the right things rather than having the machines take over. So that's one. Number 2, I think, is competitors helping each other. So in that case, the whole Barbenheimer trope was all about like 2 blockbuster movies competing with each other, 2 separate entities. And it turns out that they started kind of promoting each other. And that's what led to this. I think our industry is one of the great examples of one that is highly collaborative. It's competitive, yes, for sure, but it's also collaborative. And I think we draw a big lesson from there. And then number 3 is like, choose your style. Banking and lending on the one hand gets criticized for being a commodity. On the other hand, these 2 movies are polar opposites, and they are both having equal success at the box office because there's an audience out there for everything. Just like there's a consumer out there for the type of style that you're taking, you're tech forward, you do different channels, you do all the kinds of different ways that we manifest our businesses. And that all holds analogy wise too. So I've been staring at that and saying, oh my gosh, this is exactly like our space. And guess what? Those old school tactics kind of made everything cool again. And that's what's going to happen here too for everyone that's left standing.
That is brilliantly said, and I won't think less of you because you went to the Barbie movie 6 times. And but thanks for that analogy, buddy. It was great to spend time again. Look forward to doing it again soon.
Absolutely, Joe. Happy to be here.
Thanks so much for joining us today. Be sure to subscribe wherever you get your podcasts.